Welcome to the flagship Harbor Advisors market observations call for the week of February the 6th, 2023. Just a reminder, this replay is for advisor use only. Going to start by recapping last week, what a week it was, really what a start to the year it's been. I actually have a client letter going out later today discussing that landscape, particularly in light of last Friday's absolutely smashing payrolls report. For this call, I'm going to chat through positioning and outlook ahead. Have a quick update with respect to one of the ETFs that we own in our models. And then lastly, a quick update with respect to one of these strategies in our investment platform lineup. But starting with last week, markets up about 1.5%. That was following a big update on Wednesday where the Fed, as expected, delivered an additional 25 basis point rate hike. Expectations are for one more end of this month and then likely to pause. Interestingly enough, in his comments afterwards, many described Powell as being far less hawkish than anticipated. That's what the market sort of viewed as a all clear, and from there we're off to the races. Markets led higher last week by communications that had specifically a 25% move in Meta or Facebook after their earnings call. That stock is now up over 55% year to date. It's actually a company that we bought in two of the SMAs December 29th of last year. Unfortunately, though, party came to an end on Friday, got an absolutely smashing payrolls report, nearly 3 times what analysts were calling for. The good news with that is didn't see a huge uptick in wage growth. Obviously, that's important as wage growth highly correlated with inflation. However, still in the face of falling, but very much unacceptably high levels of inflation. In many ways, that gave the all clear for Powell to continue moving forward, or at the very least, keeping us in the higher for longer camp. Again, that's a view that we have, not necessarily calling for significantly more or higher rate hikes after the 25 in March, but same vein, don't necessarily see a scenario where we have an incredibly strong labor market and still high inflation, where Powell is cutting towards the end of this year. Again, I think that is what you really saw driving markets higher immediately following that announcement, and starting to have an effect. Down day on Friday, down to open this week as well. You've really seen that start to negatively impact yields, which have been on the climb. But recapping, market year to date up 7.7%, up over 8 through the close on Friday. One interesting stat, I sort of referenced this, but just to quantify it, that market has been led by the absolute junk. If you look at the top 10 best performing stocks, again, this is year to date through market close on Thursday, the 10 best performing stocks on average up over 50%. The price to earnings ratio for those stocks on average 43 times. Meanwhile, or sort of in comparison, the cheapest 10 stocks year to date up only 3%. Another sort of stat to help sort of just quantify the environment that we've been in, retail participation in the stock market just recently eclipsed the peak during the GameStop days. Again, historically, that would suggest not a particularly encouraging sign if you have more of the retail money driving stocks higher as opposed to institutions. And again, just to recap, when we think about markets, currently trading right around 19 times. Again, granted, though, those are 2023 estimates. Q4 earnings season, not off to a good start. We're seeing those companies track to negative 5% 2022 earnings. So again, big disconnect there between what the market is pricing in versus what the preliminary indications are. We're also seeing some of the worst beat rates on virtually every metric. Again, not an encouraging sign necessarily. From a positioning standpoint, if you have been fully invested year to date, kudos. Probably not a bad time to take some of those gains. Again, not really sure the catalyst that's going to move us meaningfully higher from here. And with a lot of unknowns on the horizon, I think there's much greater potential, for some downside versus some upside. So again, if you include a tactical strategy, positioning for the short or intermediate term, think a cautionary allocation certainly makes sense in this market. Granted, the tactical portfolios have been positioned fairly conservatively throughout the course of the year, owning both higher quality names as well as slight underweight to risk. Obviously that has resulted in some trailing of benchmarks. When we think about both the strategic and SMA portfolios, per their mandate, those both remain fully invested, and I've actually seen some very strong results, not only better protecting through the volatility of last year, but participating on the upside in the gains that we have had. Again, though, those are not strategies going out, owning some of those junk names, rather screening for higher quality names that do have some momentum attached to them. Again, we've seen those be rewarded in the environment thus far. With respect to the options portfolios that we manage within Core, this is a time where we're actually long going into the Fed announcement. Saw a quick pop there, able to take some profits, and then very quickly turn those around to be net short. Again, when we think about all of the volatility, all of the different outlooks, certainly wouldn't be surprised to see markets come under a little pressure here. What will be interesting is sort of the depth and breadth of participation. But again, now looking at 2 days between Friday and open today of fairly sharp declines, something to keep a close eye on going forward. And we think about what are some of those things you may potentially be looking to short or buy puts on. ARK through market close on Thursday, up over 40% this year. From a fundamental analyst perspective, a very speculative strategy based on rates going back to zero. In my opinion, there's probably never been a better time to buy puts on that instrument. Model performance, as I mentioned, both the tactical and to a lesser degree the technicals, those have been positioned conservatively, not surprising, have lagged benchmarks there a little bit. And then one piece I wanted to highlight, a while back, we had introduced a absolute return ETF, ticker CCOR. That's where it owns high quality, typically dividend paying names, and then we'll buy puts on the S&P 500. That strategy is designed to really capture the spread between higher quality names and the broad market. Not surprisingly, over time, the annualized return of that portfolio is right around 5%. Granted, year to date, it's down a few percentage points. And again, the rationale for that, high quality stocks have been virtually flat, maybe up a couple percentage points. But with the gains that we've seen in the broad market, obviously the cost of puts, meaning having to buy more, has increased, where you've not seen puts really pay out. With the exception of last Friday, those premiums have been 100% lost. So that strategy has come under some pressure. Probably not a bad place to think about owning that right now. Again, obviously, you're seeing markets roar right out of the gates, coming back to earth here. Do think probably more of a choppy environment, potentially with some more room on the downside lies ahead, and that ultimately would be a very good strategy in that environment. With respect to the options strategy that I mentioned in the Core platform, unfortunately, that has gained a lot of traction, and at this point, somewhat oversubscribed. We were anticipating to be able to block trade those options within enhanced trading. Unfortunately, does not look like that is going to be the case. And given the manual nature of those trades, do need to put that on pause for now. Obviously, though, anybody currently in that program, though, will continue to maintain those positions going forward. Lastly, on the geopolitical front, likely saw there was a Chinese surveillance balloon that was spotted initially over Montana that was shot down over the weekend. Once it went over water, our military forces in the process of gathering the remains of that. Best recap of this whole scenario, what's going on, the likely motivators, came from Bloomberg's Anne-Marie Horden, where at the end of the day, her best guess based on all those contacts was this was simply just a message Chinese President Xi Jinping sending to the nationalist folks within his party, without in the same vein directly prompting or aggressing with the U.S. We'll see. Obviously, very interesting timing with our Secretary of State slated to be going over there very shortly. And then on the week ahead, a relatively quiet week for data. Obviously, we do get a handful of earnings. State of the Union on Tuesday. And then this weekend coming up, have the Super Bowl. First time that two brothers have faced off head to head. As well this week, LeBron James currently 36 points behind breaking Kareem's all-time scoring record. All indications are he would likely earn that title at some point this week. And then friendly reminder, Valentine's Day, 8 days away. Make sure to make those reservations, get those flowers and chocolates, etc. That's all for now. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.